Good afternoon or good evening, wherever you are. Welcome to Xeneta's Q3 Shipping Rates at a Glance webinar. My name is Catherine Barrios. I'm CMO at Xeneta, and I'm joined by our CEO, Patrick Berglund, who is today's presenter. Hey, Patrick. Patrick is in New York, and I am in Norway, and we're using the webcam today. So we thought it would be a good idea if everybody saw who we were. So this is us. Hello. If we just move on to the next slide, I wanted to oh, I lost the share. There we go. This is us again. I would be remiss of me not. It would be remiss of me not to mention of Patrick's award a couple weeks ago of Lloyd's List Next Generation and Shipping Award. So I have to mention that again. Congrats, Patrick. We've had a good group of people on the line, or so far we have a good group of people. Thanks for joining us. There's some housekeeping items. So the webinar is scheduled for 30 minutes. 25 minutes of it is for the presentation and 5 minutes is for Q&A. Everyone will be on mute, but you can ask your questions in the question box that's to the right of your screen on the webinar tool. There's a little box that says questions, so feel free to drop your questions there throughout the webinar, and we'll answer those at the end when Patrick completes the presentation. If we go to the agenda, we have about half of the people that have registered are new to Xeneta, so we are going to start off with an overview of Xeneta, talk a little bit about the platform, how we gather the data and some of our key strengths. Then we'll move into looking at the main highlights of last quarter of Q3. We'll also give you sort of our view on the current state of the market. We'll talk a little bit about the Hanjin effect so far, and then Patrick will jump straight into the platform and give you a live overview, focusing on the two main routes, which are the ones that are on your screen now, and as well give you an analysis on the short-term rates and the long-term rates and an outlook as we move into the end of the year and perhaps moving forward as well. Then we'll wrap up with a Q&A, so we'll look at all the questions that you've posted in the tool, and Patrick will do his best to answer all those questions. We are recording this session, so if you've registered, if you've attended, you'll receive it, the session recorded over email by tomorrow. And that said, I think we're ready to start. So Patrick, it's your go, and I'll put myself on mute.
Thank you, Catherine. Appreciate it. So let's, as Catherine mentioned, we have a few new ones on the lines. About half of it haven't joined these webinars before. So let's cover the basics before we go into the tool and also talk about the highlights of Q3. So Xeneta is an online ocean rate freight rate benchmarking platform, and we're headquartered out of Oslo, but we have local presences now in, as Kathy mentioned, in New York and in Hamburg, and we have more than 600 companies connected to our platform and more than 2,000 users, some of them mentioned on this slide, that feeds in data to our platform. So a few key core things to keep in mind. The main value driver of our platform is the data coming from the network connected to our platform. And we have more than 17 million contracted rates in our platform currently, growing every day. And these contracted data points, they allow us to publish indexes on more than 60,000 port pairs, so trade routes around the world. And we're going to be looking at trade routes within the two largest corridors today, namely Far East Asia into main ports, into North Europe main ports, and US West Coast. The data is, as I mentioned, updated daily, and our company is a neutral company. There's no stakeholders in the industry that has an ownership stake, whether it's the BCO, carrier, NVOCC, or freight forwarding side. Now, we source the data mainly from the shipper or the consignee. So a shipper or a BCO that's in control of the freight contracts in a supply chain uploads the data into our platform. But we also source our data from the NVOCC side, and we group group that data so that the users can filter on it. And it's mainly named account basket contracts, named account contracts, or freight all kind prices that comes in. Everything is aggregated into these groups so that the users can slice down the data and have a look at what they really want to see in our platform. So a couple of highlights before we start looking at the actual tool. And first, we'll look at the short-term rates, as you can see on this slide. Short-term rates between Far East Asia main ports into North Europe main ports, where if you take an isolated view on Q3, there was actually a drop in the market average prices. So the market average came down during Q3, but the lower end of the market was lifted so that the spread of the market got reduced. And it's important to understand that there's been, on a longer time perspective, it's been a pickup of the market, it's been trending upwards, and that is what we're going to see in the tool, but this is purely isolated on Q3. So short-term rates going from Far East Asia main ports into North America Southwest coast has seen a significant increase during Q3. And both of these corridors have been impacted by the Hanjin bankruptcy, and we will also take a look at how that looks like with the data in our platform. On the long-term contracts, it's the opposite of what we just looked at for the short term. Here you will see the corridor going into North Europe main ports that has the biggest increase for short-term contracts, and there's an even more significant increase in this market if you filter out all the old data, meaning that you only look at contracts that were negotiated within the last 6 months. So these 47 and 11% is significantly more by slicing the data that way, and that I will show in a bit when we go into the tool. Into North America Southwest coast, it's been a steady market, so it seems more to bottom out and might be picking up now, and we'll look at the data behind our charts while browsing the platform to further underline this point. A couple of market events or trends that we wanted to cover before we go into the tool. So over the last couple of years, we've seen vast amounts of over capacity in the industry that has driven down prices both for short-term and long-term. So it's been a constantly downwards trending and spiraling market. It seems to be picking up now that we've seen a lot of M&As and alliances in an attempt to turn the market situation around. And now, since March and April, May for US corridor, we've seen it trending upwards. There's also a change in mindset that we see in the industry. There's more interest in exploring new ways of structuring contracts, of getting market insights and intelligence, and rather than a nice to have these days, it's perceived as a must have. And we wanted you to take these few items with you when we go into the tool, but one key thing to remember, and this sums it up really well, that a slumping market will at some point recover, and that imposes different things to consider from a shipper BCO side, and that would be the risk of getting short shipped. So we actually have customers on our platform using the data now proactively to make sure that they have a competitive price, but that it sits in a position in the market that reduces some of this risk for them, simply because of the cost of getting short shipped or rolled vastly outcompetes at $100, $200, or even $500 saving when you compare it to cost of lost sales. So with this being said, let's take a look at our tool online. And I wanted to start with the Far East main ports into North Europe main ports. So what we're looking at here is Q3 isolated. I've selected a 40-foot container and short-term contracts. So you will see here a few things. First and foremost, we entered the quarter on the back of a substantial GRI that, as historically we've seen the same pattern, that they trend downwards and then a new GRI gets introduced and then it trends downward. This is the pattern we've seen over the last couple of years, 3 years even. But in September here, there was a slightly different behavior in the market for the first time. So the Hanjin bankers came into play, and the market didn't fall down. It actually continued to increase, as we will probably all picked up in media as well. But I think it only took to mid-month before prices starting falling again. So in the end, going out of the quarter, there was actually a reduction, and the 40-footer stood at $1,500, while going into the quarter, it was a 952. So if we look at this in a percent change using this button, you will see that going into the quarter, before the first month of the quarter was completed, the market was down with 28%. Then they only managed to bring it up so that the reduction from first day of the quarter was down 8%, and then another bottom, and at 27, the Hanjin effect compensated some, but then going out of the quarter, the market was down with 23%. On average, by using the slider at the bottom here, the market was down a combined 18% over the quarter. Now, that doesn't look awfully good for the supply side of the industry, but if we take a slightly longer time perspective on this and look at Q2 and Q3 in a combined view over the same time period, Q2 and Q3, you will see that the market has actually trended upwards. But it seems to be somewhat flattening out if I apply this trend line here. But historically we know that they've been very good at the carrier side at pushing up the prices towards Chinese New Year. And if we compare this year with last year, this is actually a much better starting point towards Chinese New Year to push it further up. And considering then that the main tender cycle for this corridor is accordingly to the calendar year, it might be that they will have the carriers will have a much better starting point to negotiate next year's long-term contracts, based on the fact that they've managed to pull up the short-term market. You see that it bottomed out here in April, and at $662 per 40-footer. Now it's at 1,500, so it is a significant increase. Now, then I want to look at long-term contracts Q3, because when we started the third quarter, long-term contracts sat at $902 for a 40-foot container on this corridor. So you will see that there's hardly any change going out of the quarter. It's 958, not a significant movement there. But what's interesting is if we take a slightly longer perspective in this and look at year to date, you will see that it's kind of bottom out, similar to what we've seen in the short-term market. A bit earlier here, we're talking Q2, Q3, and then it's actually been slowly picking upwards. And the key thing here to look at is that we need to eliminate the old data that still is contracted at a low level and see what's been negotiated over the last 6 months. Now, by slicing out that type of data, you will see that back in April, the average was at 361, while now we have today an average of 965. And this is actually, if I check this out as a percent change to start, this is 168% increase, meaning it's a 2.67% multiplier almost. So this is definitely picking upwards, and if, as I mentioned, they further manage to pull up the short-term market, they will have a fantastically beneficial situation negotiating long-term contracts now towards end year. One more thing that I mentioned initially is for the short-term market. If I go back to this one and also have a look at how they managed to reduce the spread in the market, I can simply look at how the market has moved relatively to the lower end of the market. So the interesting thing about this is that if you go back to April, the lower end of the market paid 50% less than the average. So now the average is set as a constant 0 point, while today that spread is reduced so that the lower end of the market pays less than a third less, so almost 30% less. And we've seen this same pattern on the market high side as well. So the spread has been narrowed, and it looks to be a very beneficial position with these things combined going into contract negotiations for 2017. So what I want to do to get this point really solidly across is that I want to look at the underlying data in the platform. So I prepared this slide to have a look at this. So what we're looking at here is a snapshot, a few thousand contracted data points on this corridor, and we have several 100,000 here. But in order to be able to read anything out of the chart, I've narrowed it down to 15,000 contracted data points. So the length of the line here represents the contract duration, meaning that the short lines are short-term prices and the longer lines are long-term prices. On the y-axis, you have a US dollar value that shows the level of the US dollar value of the contract within this corridor. And then you have a timeline at the bottom. And you see that I've chosen to go all the way back to 2015. And in 2015, the red square here is circled around the main chunk of long-term contracts on this corridor. So there's a cluster there. And this cluster was negotiated on the back of a much higher short-term market that we saw in 2014. Now, in 2015, things really changed in the market because the spot and short-term market moved down, which also indirectly tells us that smaller volume BCOs had a cheaper price within this corridor than larger volume BCOs, because larger volume BCOs typically goes on longer term contracts. So they tried to pull the short-term market up towards Chinese New Year. As I mentioned, that's a clear pattern that we see, and it was simply too late for that tender cycle. So the large BCOs that tendered their contracts going into 2016 moved down their average prices. And you clearly see that all of the long lines moving down, not everyone, but the main cluster of it. That means a large volume of boxes were moved at a significantly lower price than the year before. So we already in 2015, when we started getting this data, we could already conclude that unless they significantly pulled up the short-term market, it would be a very difficult year for the carriers. And we've seen the Hanjin consequence. And they didn't succeed in pulling up the prices for the short-term market. It went all the way down to an all-time low level. And now they've been more successful in trending it upwards, as you can see here. And the key question and what really needs to be looked at now going into the tender cycle is that if they can further pull these short-term prices up with the Chinese New Year coming into play, then the long-term prices will also move up, and it will probably do a substantial bump. And in order for the carriers to reach something that would look like a sustainable market for them. We will start getting data this quarter into that last red square there with a question mark, and that will be very interesting for us to see now moving forward. So with that covered, I want to go back to the platform, and I want to move focus over to North America Southwest Coast. So I want to do some of the same exercise here. So what we see is that this corridor, as we mentioned, has picked up way more on the short-term prices compared to the European counterpart. It's very important to understand that the tender cycle on this corridor has its major negotiation point in May. That means that there's a bulk of contracts expiring in May, and this pattern that we're seeing here corresponds with what we've seen in Europe, but with a quarter and a half delay. So the short-term market here has moved initially as we went into the quarter, Q3, it was $1,240 per 40-foot box, and then Going out of the quarter, it's at 1,826. Now, if we then take a look at this in a slightly broader perspective, including Q2 and Q3, you will see that the market bottomed out on $782 on average in April. The spread of the market was, the lower end was at 642, and this is all short-term data. And it clearly shows a trend that moves upwards, which will impact the longer-term contracts. But if you look at the longer-term contracts, as I mentioned, in combination with the tender cycle, you will see that it's only since it's in May you had this big drop where it moved and adjusted relatively to the short-term market. So now it will we expect it to flatten up and pick up. And if I click the trend lines here, you will see that the underlying data behind also further supports that this market is about to pick up. Another strong indicator that we have about this market picking up is that we're getting a lot of reports from our network, whether it's the NVOCC side or the BCO side, that it's difficult to get down to the lower end of the market now. While if you go 6-9 months back, it was much easier to secure the lower end of the market if you run with a fresh new RFQ. But the fact that there's reluctance to negotiate long-term contracts at the bottom end of the market gives a very strong indication that there's expectations that the market also will be picking up, so that better contracts can be achieved from the carrier side a little bit further down the road. So we expect to see some of the from how what we've seen our data earlier and what we interpret is that the European corridor, as it tenders end of year, and this North American one tenders May, then we expect to see the same movements as we've gone very much in depth on the European one, be reflected into the North American one. Now, this is what I intended to show during this half hour today, and now we will open up for some Q&As questions. I see that there's a few ones already listed here. There is a question about this being long or short-term rates. So we looked at both short and long-term rates. It's very easy to see out of the granularity and the volatility level which one were short-term and long-term. And you can freely switch between those in the platform. And with that question, I think that's about it. The rest is answered in the chat. So if there's any other questions, I'll stay on for another minute. Otherwise, if there's not, I'd like to thank everyone for joining today. There's another question. Where did you get the NVOCC data? So the NVOCC data is fed directly from the connected NVOCCs. We have some of the largest NVOCCs in the world connected to the platform, and also smaller regional and national ones. So I think that covers it, Catherine, for today. If there's any other questions later on, we'll be more than glad to answer those. You can reach out by email, or we will make sure to circulate the recording as well. I guess you can round it up for us, Catherine.
Sure. Thank you, Patrick. As Patrick said, the recording will go out tomorrow. So if you have any questions, you can reply to that email, or you can contact us via our website. I also want to take the opportunity to invite you to follow us on our blog, to xeneta.com/blog. We post about 3 to 4 blog posts a week on varying topics on shipping and supply chain logistics and etc. You can subscribe to that and get instant messages or weekly updates. So that is up to you. And one other thing, a couple of events will be present next week, October 19th through the 21st. If you're in Germany and are at the BVL event in Berlin, we invite you to stop by our booth and we'll be happy to answer any of your questions. And if you're in the US, in the Midwest, on November 9th, we'll be coming to Chicago for a Meet Xeneta seminar. We had one last month in New Jersey, and now we're moving to the Midwest in Chicago. Patrick will be there, as well as William Dieso, who's our Director of Business Development for North America. So they'll be present, and we'll have a 2-hour seminar there. So I invite you to um, register for that if you're in the area. Other than that, if you have any questions, again, please contact us and we'll be happy to answer those. Thanks a lot. Have a good night or good afternoon. Bye, everybody.
Bye.